Welcome to the deep dive.
Great to be here.
Today, we're diving into something that's probably part of your everyday life, maybe without you even thinking about the term: electronic money, e-money.
It's everywhere.
Exactly. And we're using source material you gave us, specifically an article from FinCrime Intelligence, to kind of guide our chat.
That's right. A really insightful piece.
Our goal here, our mission for this deep dive, is really to pull out the key takeaways from that source. Understand what e-money actually is, why it's, well, blown up in popularity, what the potential problems
The
are,
risks, yeah.
risks, how it's kept secure, and importantly, how it stacks up against, other digital ways of paying.
Like crypto and things like that.
Precisely. Think of this as us giving you the map, the essential insights, so you don't have to wade through all the dense material yourself.
Getting right to the heart of it.
Okay, let's unpack this then, starting right at the beginning. What is e-money? Fundamentally.
Yeah. Well, at its simplest, e-money is just a digital version of the regular money you use every day. Your dollars, euros, pounds.
So not a new currency itself.
No, absolutely not. That's key. It's just your normal fiat currency, but held and used digitally.
Okay, like my cash just lives on my phone or a card instead of my wallet. But the source mentions some specific traits that make it different from, say, just seeing my bank balance online. What are those?
Yeah, it has a very specific definition, legally speaking. The article highlights a few core things. First off, it's prepaid value.
Prepaid, meaning you load money onto it first.
Exactly. You put the money in before you spend it. And as you said, it's stored electronically. Could be on a card, maybe in a mobile wallet like Apple Pay or Google Pay, or, within specific apps.
Okay. Prepaid, stored digitally. Got it. What else?
Another defining point from the source is what it's for. It's specifically designed for making payments to other people or businesses, not the company that actually issued the e-money to you.
Ah, okay. So it's meant for transactions outward.
Right, and this is super important. It's always denominated in fiat currency. It's directly tied one-to-one to a national currency, USD, UR, GBP, whatever it might be.
So unlike crypto, its value doesn't fluctuate on its own. €1 of e-money is always worth €1 cash.
Precisely. That one-to-one value, or par value redemption, as the jargon goes, is guaranteed. It is that currency, just in digital form.
That feels like a critical difference. It's not trying to be Bitcoin.
Not at all. And underpinning that stability is the fact that it's issued by regulated institutions.
Okay, so not just any tech company can start issuing e-money.
No, they need specific licenses and have to follow strict rules. And a huge part of those rules, maybe the most critical safeguard mentioned in the article, is that the customer funds backing the e-money must be held in special safeguarding accounts.
Safeguarding. What does that mean in practice?
It means the issuer has to keep your money completely separate from their own company funds. Ring-fenced.
Ah, so if the provider, say, went bankrupt.
Your e-money funds should still be protected, because they're held separately. It's a massive piece of consumer protection.
Wow, okay. That is fundamental. So just to recap, regulated prepaid, digital fiat, redeemable one-to-one, and crucially, safeguarded.
You got it. That's the essence.
We probably bump into this constantly then. What are some everyday examples the source points to, things people might recognize?
Oh, definitely. The article mentions things like those prepaid debit cards you can buy. Digital wallets are a huge one. Think PayPal, Revolut, Wise, services many of us use for online shopping or sending money to friends.
Right, I use some of those.
And also things like mobile money systems. M-Pesa is the classic example, especially powerful in places like East Africa. They've transformed payment access there.
So it really spans from like your coffee shop loyalty app balance maybe to these huge global payment systems.
Pretty much, yeah, wide range.
Okay, now that we've nailed down what it is, let's get into why it's become so popular. I mean, the convenience seems obvious, right?
Absolutely. The benefits really flow from those characteristics we just discussed: speed, ease of use, the digital nature. It often just works more smoothly than older banking methods for certain things.
What are some of the big use cases highlighted in the material? Where is it making the most impact?
Well, the list is long. For individuals, it's everyday stuff. Topping up your phone, paying bills online, subscriptions for streaming services.
Yeah, the small, frequent payments.
Exactly. But also bigger things. Remittances, sending money internationally, is a massive area. E-money platforms often offer much faster and cheaper ways to send money home compared to traditional banks or wire services.
That's a huge deal for millions of people, a real tangible benefit.
Definitely. Then there's travel, using prepaid e-money cards abroad for security, maybe better exchange rates. Even governments use it now
Governments, how so?
for distributing payments efficiently. Things like social welfare benefits, emergency aid. It can be much quicker and cheaper to send it via an e-money system than printing and mailing checks, for example.
Makes sense. Cutting out the middleman.
And a really important point the source stresses is financial inclusion.
Ah, right. Access for people without bank accounts.
Precisely. In many parts of the world, more people have mobile phones than traditional bank accounts. E-money systems running on those phones give them access to digital payments, savings, maybe even credit down the line. It's incredibly important for economic development.
So it's not just about convenience for those of us already banked. It's genuinely opening doors. What about businesses? Any benefits for them?
For sure. Handling cash is expensive and risky for businesses. E-money reduces those costs. Card processing fees can also be high. Sometimes e-money offers cheaper alternatives. Plus, it lets them offer that smooth, integrated, frictionless digital experience customers increasingly demand.
Okay, so loads of benefits driving adoption.
Right.
Speed, cost, access, convenience. But you mentioned regulation earlier. Because it is money, it needs rules. Let's dig into that.
Yeah.
Why is regulation so vital here?
Well, it's fundamental. Anytime you're dealing with people's money, you need rules to prevent abuse and build trust. The main goals are stopping financial crime, like money laundering or terrorist financing, making sure customer funds are actually safe, like we discussed with safeguarding,
Right, the safeguarding point.
and generally ensuring the whole system is stable and reliable. Without that regulatory framework, people just wouldn't trust e-money providers with their cash.
And the source mentioned it's not quite the same everywhere, regulation-wise.
That's right. The principles are similar globally, but the specifics can vary quite a bit. The EU has its framework, the EMD2 Electronic Money Directive. The UK has its own electronic money regulations, overseen by the FCA.
And the U.S.?
In the US, it's often more fragmented. You've got state-level money transmitter licenses, plus federal oversight from bodies like FinCrime, particularly for the anti-money laundering side. So it's a global concept, but with local flavors in the rule books.
Despite those differences, what are the kind of core requirements that the article says most regulators impose on these e-money institutions?
Okay, some key pillars are almost universal. Number one, as we've said, is safeguarding. That absolute requirement to keep customer money separate and protected.
Non-negotiable.
Totally. Then transparency. Clear rules about how you can get your money back redemption and what fees they charge. No hidden surprises.
Makes sense. What else?
A massive area is AML-CTF compliance, anti-money laundering, and counter-terrorist financing. This is huge. It means providers must do customer due diligence, or CDD, basically know who their customers are.
So verifying identities, like when you sign up for an account.
Exactly. And often there are limits. You might be able to hold or transact small amounts with fairly light verification. But if you want higher limits or to cash out, you'll need to go through more rigorous KYC and know your customer procedures. Uploading ID, proof of address, that sort of thing.
Okay, so controls based on risk and value.
Right. And finally, they have strict reporting obligations. They need to report certain data to regulators and, crucially, report any suspicious transactions they detect.
Sounds like a lot of hoops to jump through, but necessary ones.
They are. They're designed to build that trust and make it much harder for criminals to exploit the system.
But inevitably, criminals do try. The digital convenience must have a dark side. What are the specific risks the source highlights, especially around financial crime?
Yeah, this is the constant challenge. The very things that make e-money great, the speed, the ease of opening accounts sometimes, the cross-border nature, are exactly what can attract criminals if the controls aren't strong enough. The article really digs into this tension.
So what are they actually doing? What kinds of schemes?
Well, the source points to a few common typologies. Using anonymous or lightly verified prepaid cards to move illicit funds is a classic one. We've seen that for years.
Right, the disposable card idea.
Exactly. Another technique is structuring, breaking down large amounts of dirty money into smaller transactions to fly under the radar of reporting thresholds.
Trying to stay below the limit where the provider has to report it.
Precisely. There's also fraud related to opening accounts using stolen or synthetic IDs, or simply taking over legitimate accounts. And as we touched on, mobile money systems in places with weaker regulatory oversight can sometimes be exploited more easily.
It feels like a continuous game of cat and mouse. So how do the legitimate providers fight back? What specific compliance tools does the article say they must use?
They have to have a multi-layered defense. Robust KYC is the starting point, really verifying who people are, especially for higher risk activities. Then sophisticated transaction monitoring systems are crucial.
What do those do?
These are software systems that analyze patterns and transactions in, ideally, real time. They look for red flag structuring, payments to sanctioned countries, unexpectedly large volumes, weird patterns of activity for a particular customer, things that look suspicious.
Like automated detectives.
Kinda, yeah. They flag things for human analysts to review. Providers also have to perform sanctions and PP screening. Politically exposed persons. Basically, checking customer names and counterparties against official lists of sanctioned individuals, terrorists, and high-risk politicians or officials.
Okay. Checking against blacklists.
Right. And strong customer authentication, SCA, is increasingly mandated, especially in Europe. Things like two-factor authentication when you log in or make a payment to prevent account takeovers.
Making sure it's really you doing the transaction.
Exactly. And if they do spot something suspicious despite all this, they have a legal duty to file a suspicious activity report, or SAR, with the relevant Financial Intelligence Unit, FIU. Plus, they need to keep detailed records audit trails for regulators to inspect.
It's a complex web of preventative measures. Which brings up a really important question.
Mm.
How does all this regulated e-money differ from, say, Bitcoin,
Mm.
or those digital currencies central banks are talking about?
Yeah, that's a great question. And the source helps clarify the distinctions. It's helpful to think about them as different categories.
Yeah.
So first, you have cryptocurrencies like Bitcoin, Ethereum, etc. Key features. They're generally decentralized. No single company or government issues or backs them. Their value can swing wildly. And crucially, they're typically not considered legal tender linked to a fiat currency.
Right. Very different world.
Yeah.
Volatile, decentralized.
Very. Then, at the other end of the spectrum, you have the potential future concept of central bank digital currencies, or CBDCs.
The digital dollar or digital euro idea.
Exactly. If these launch, they would be a direct liability of the central bank, like digital cash issued by the state itself. Still mostly in development or pilot stages around the world, though.
So where does our e-money fit in between those two?
E-money sits firmly in the regulated centralized space today. The absolute key differences from crypto are it's fiat denominated, that one-to-one value. It operates under existing government regulatory frameworks, and because of that, it offers much greater legal certainty and consumer protection, especially through safeguarding.
So it's digital convenience, but within the established system, not outside it.
Precisely. It's distinct from the Wild West of crypto, and also different from a potential future state-issued digital currency. It's privately issued digital fiat under license.
That really clears it up. It occupies its own specific regulated niche. Looking forward then, where does the source material see e-money heading? Is it still growing?
Oh yeah, the article suggests strong continued growth. The overall shift to digital payments isn't slowing down, and e-money is a big part of that engine. Plus, there's ongoing innovation.
What kind of innovations are we talking about? What's next?
Well, we'll likely see even tighter integration with things like contactless payments and biometric authentication. Paying with a fingerprint or facial recognition might become more common via e-money wallets.
Making it even faster, I guess.
Faster and potentially more secure. There's also growth in API-based payments, which allow for really slick instant payment integrations for businesses. Think instant business-to-business settlements.
Okay, more behind-the-scenes stuff.
Some of it, yeah. Also, multi-currency wallets are getting better, making it easier to hold and spend different currencies when you travel or shop internationally. And there's even some talk, though it's early days and regulators are watching very closely, about e-money potentially acting as a kind of regulated bridge between traditional finance and some parts of the DeFi, decentralized finance world.
Interesting. So linking the old and the new.
Potentially in very controlled ways. But innovation is definitely happening. And alongside that, the source notes that regulators globally are trying to harmonize their rules more.
Why is that important?
Well, because e-money flows across borders so easily, having wildly different rules everywhere creates loopholes for criminals and complexity for legitimate businesses. Harmonization aims to manage those cross-border risks better while still supporting safe innovation.
Makes sense. A more consistent global approach.
Exactly.
Okay, so let's try and pull this all together. We've gone from the basic definition, e-money, as regulated, prepaid, safeguarded digital fiat through all its uses, from your daily coffee to global remittances.
The crucial rules that govern it, the financial crime risks it faces, and how providers fight back.
how it's distinct from crypto and potential CBDCs, and now a glimpse of where it's headed with things like biometrics and APIs.
Yeah, I think the main takeaway from the source is that e-money is really a fundamental piece of the modern economy now. It's built on providing convenience and speed, yes, but that only works because it's underpinned by these vital regulations designed to keep money safe and combat illicit use.
It's probably woven into your life more than you think. How many times today might you have used an e-money service without labeling it as such? Paying for parking with an app, maybe that online purchase, sending £10 to a friend?
Mm-hmm. It's often invisible, just part of the plumbing.
So here's a final thought for you to chew on based on our dive into this material. As e-money gets even more advanced, maybe using your face or fingerprint to pay instantly, becoming almost unconscious.
Yeah.
How does that evolving technology and the regulations trying to keep pace affect your own feeling of trust and security when your money moves digitally, almost invisibly? Something to think about.
A really interesting question for the future.